Hi everyone. We are now going to take a look at the practice problems from chapter 15, starting with 15-B, which is on page 562. So Paris Inc. began operations in year 1, following a series of transactions and events involving its long-term debt investments in available for sale securities. So the first thing we're going to do is prepare the journal entries to record these transactions and events and any year-end fair value adjustments to the portfolio of long-term available for sale securities. So let's start with March 10th of year 1. The company purchased Apple bonds for $30,600. So we would debit debt investments, which is an asset account available for sale, AFS, $30,600, and credit cash. April 7th, now they're going to purchase Ford notes. So another type of debt, but instead of buying bonds, they're purchasing a note payable, a loan. So they're going to debit debt investments available for sale for the amount $56,250 and credit the cash. September 1st, when they purchase Polaroid bonds for $28,200, they're going to debit debt investments available for sale and credit the cash. Now, they tell us at December 31st that the fair values for the debt in the portfolio for Apple is $33,000, Ford $54,600, and Polaroid $29,400. So that is the value of those bonds at the end of the year. And we know from our discussions on chapter 15, available for sale debt investments, what does that mean? It means we're going to hold the debt longer than a couple months, but not to maturity. And when we're in this category, available for sale, and that's what makes us in that category, this debt investment in this category, the holding period, we need to report the debt investments at their fair value on the balance sheet. So I'm actually going to scoop down to part 2. Okay. Oh, I don't need to. It looks like they did part 2 for us. No, here's part 2. So at the end of year 1, I don't like this. That's not correct. Oh, that's because I'm in the wrong problem, right? Oh, you guys put up with me. Okay, so at the end of year 1, here's what we'll do. We're going to say, what were the total costs of all the bonds we bought? And we would just add the $30,600, $56,250, and the $28,200. So right now in our debt investment available for sale account, the debit balance is $115,050. We also do the same thing with the fair value. So add up the fair value of each, and that was given in our problem. $33,000 for the Apple stock, $54,600 for Ford, not stock, debt. Polaroid, $29,400 is the fair market value of that debt, not stock, debt. It's getting late in the day. Add up those fair values. So the total fair value of our debt investment available for sale is $117,000. The current balance in our account, or what we originally paid for them, $115,050. So they actually went up in value. So when we report the debt investments on our balance sheet at the end of year 1, their value must be $117,000 on the balance sheet. Well, we need a way to increase how we report this asset, because right now, if we just reported it the way it is in our accounting records, we would be reporting it at $115,050. Well, we debit or increase a special account that is used to increase or decrease our debt investment in this case. So since we need to report this debt investment at a higher amount, we must debit it so that we could add the cost, the debit in the debt investment account of $115.50 to the debit in the fair value adjustment account of $19.50. The credit is to an unrealized gain. Yeah, because it increased in value. So it's a gain, but it's not one that's actually realized. Realized gains happen when we actually sell the stock and get more cash than we originally bought it for. Now, notice it says the word equity there, not because this is an unrealized gain on an equity investment, but because that's where we report this unrealized gain, directly in the equity section of the balance sheet. So when debt investment goes up or down, the fair value, the unrealized gain or loss must be reported directly within stockholders' equity on the balance sheet. And we talked about this, but now you see it in action. So remember that. Right now, our fair value adjustment account, I'm just doing a quick T account on a piece of paper, has a debit balance in it of $19.50 as of the end of year one. Let's go to year two. Oh, look at that. I didn't even realize that was there. Look how nice. That's what I just told you to write down. That's because you want to remember that. Now going into year two, April 26th, the company sold, they sold all of the Ford notes for $51,250. Now they originally, up here on April 7th, remember here's where they bought them. And they bought them for $56,250. So that was the cost. They're selling them for less, $51,250. So if we subtract the cost from the selling price, they sold them for $5,000 less. So here's how we do the journal entry to account for the sale. Debit cash for the selling price. That's how much the company is receiving. We credit the debt investment available for sale for the original cost that we paid for the Ford notes. The difference in this case, the loss, is debited. Losses are treated like expenses. They increase on the debit side. Loss on the sale of debt investments. Now, so you know, and you want to jot this down, that account balance is reported on the income statement in the other gains and losses area. And it would decrease net income just like an expense does. June 2nd. Now the company purchased more bonds, Duracell bonds, and they bought them for $34,650. So debit debt investment available for sale, credit cash for the $34,650. June 14th, they purchased Sears notes. God, is this old, huh? Sears is gone. It's very limited. I don't even know if it's still out there. For $25,200. Debit debt investment available for sale for the cost, credit cash. On the 27th, they're going to sell the Polaroid bonds. Now remember, here's where, oh, I didn't mean to do that. Up here is where we bought the Polaroid bonds last year. So the original cost of the Polaroid bonds was $28,200. We're selling them for $30,600. So subtract the cost from the selling price, and we have a gain of $2,400. They sold them for $2,400 more than they bought them at. So on the 27th of November, debit cash, increase the cash, decrease the debt investment account for the original cost of the Polaroid bond. The gain is credited. Gains are treated the same way as revenues. They increase on the credit side. Gain on sale of debt investment will be credited. Now, this account is reported on the income statement in the other gains and losses area, just like your loss on sale of debt investment. So we keep track of any losses on sale in a separate account from any gains on sale. And that's how we would do the accounting. Now, what do we still own? Well, we still own the Apple bonds. I mean, I keep saying stock. I apologize. Apple bonds, we still own them, right? The Ford note was sold. The Polaroid bonds sold. We purchased Duracell, and we purchased Sears. So at the end of the year, we have to make sure we only include in our determination of total cost the bonds and notes we still own. So the cost of the Apple bonds, $30,600. The cost of the Duracell bonds, $34,650, and the cost of the Sears note, $25,200. So in our debt investment available for sale, $90,450 would be the current balance, because that's the cost of the bonds and notes that remain. They tell us the fair value. Apple bonds, $31,000. Duracell bonds, $32,400, and the Sears notes, $27,600. So add up the fair value. So right now, the fair value is still more than the cost, but only by $550. Go back. What is our fair value account currently at? A debit balance of $19.50. Well, what we just figured out is what the new balance should be in that account, because we only need to add $550 to the $90,450. And remember, it's the account balances that are added together. The balance of the debt investment and the balance in the fair value adjustment account. So the new balance needs to be $550. So that means we need to credit the fair value adjustment account $1,400 to get it from a $1,950 debit to a $550 debit, and we will debit unrealized gain equity. So that account we credited at the end of last year, we debit. And that will accomplish the goal. So at the end of year 2, now our fair value adjustment for our available for sale will have a debit balance in it of $550. So please make sure you follow that and ask any questions you may have. Year 3 then, here we go. Ooh, now they're going to purchase Coca-Cola bonds for 40 grand. I think we're pros at this now. Debit the debt investment available for sale account, credit cash. They're going to sell those Apple bonds, and they're selling them for $25,800. They originally bought them at $30,600. So they're selling them for less, $4,800 less. So we debit cash for the selling price, the amount we're receiving when we sell them. Credit the debt investment available for sale for the original cost. And then, since we sold them for less than we originally bought them at, debit the loss on sale of debt investments. Just give me 1 second. Okay. Next, purchase Motorola notes for $84,000. Debit the debt investment available for sale, credit cash for the purchase price of $84,000. Now on October 9th, we're going to sell the Sears note for $28,800. We originally bought it back up in year 2 on June 14th for $25,200. So we're selling it for more, $3,600 more than we originally purchased it. Debit cash for the selling price of $28,800. Credit the debt investment account for the original cost. We want to reduce that account for the original cost because we don't own it anymore. And then the difference is credited to gain on sale of debt investments. Our final sale on October 31st, we're going to sell the Duracell bonds for $27,000. We bought them in year 2 for $34,650. So we're selling them at a loss of $76,50. Debit cash for $27,000. Credit the amount we originally bought them at to the debt investment account, $34,650. The difference, since it's a loss, will be debited to the loss on sale of debt investments. So now we sold the Apple bonds, don't own them anymore. We sold the Duracell bonds, don't own them anymore. And we sold the Sears note. So what does the company still own in this category of investment? The Coca-Cola bonds they paid $40,000 for, and the Motorola notes they paid $84,000. So at the end of year 3, they're going to list those two with their costs. So right now, our debt investment available for sale has a debit balance in it of $124,000. The fair value of those is $130,000. So they're a lot higher than their costs. So that means they've increased in value to $6,000. Remember what we just figured out. What the new balance must be in our fair value adjustment, because we want to be able to add that $6,000 to the debt investment balance of $124 and report these investments on the balance sheet at $130,000. So we just need to increase the fair value adjustment account for the $54.50, and then we will credit unrealized gain equity for the $54.50. So that's how we report purchasing, selling, and that end of year fair value analysis for debt securities available for sale. Now, in part 2, they just want us to do a table that summarizes the total cost of all of the securities at the end of each year. So if we go back up here, here's our first one. At the end of year 1, there was $115,050 as a debit balance in our investment account, and the fair value account had a debit balance of $1950. So they just want us to show that. So the total fair value that's reported on the balance sheet would be $117,000. End of year 2, the total cost that's in the debt securities account, $90,450. $550 will be added to that so that we report the investments at their fair value at the end of year 2, $91,000. And then finally, year 3, $124,000 is the balance in the debt securities or debt investment account. We'll add the balance of the fair value adjustment account to that so that we could report the investments at their fair value on the balance sheet at the end of year 3. The next wants us to prepare a table that summarizes the realized gains and losses, the unrealized gains and losses on the long-term available for sale debt securities at each year end. So in year 1, we didn't sell anything, so there's no realized gains or losses. But we did have an unrealized gain of $1950 because our securities went up in value by the end of the year. During year 2, we had a realized loss on the sale of the Ford and a realized gain of $2,400. And you could just go back up to your journal entries to see that. There's the $2,400 loss or gain. There's the $5,000 loss. So overall, we had a $2,600 loss that would be reported on our income statement. Our unrealized gain account, which goes on our equity section, has a balance of $550. End of year 3, we had a $4,800 loss on the sale of that Apple, $3,600 gain on the sale of Sears, and a $7,650 loss on the sale of Duracell. So our loss account overall on our income statement, $8,850. Well, I should say we'll have a $3,600 gain account and then a $12,450 loss. They net together though, overall they would decrease net income $8,850. And the balance in our unrealized gain or loss at year end will be $6,000. Okay, so just showing you how that all jibes together. The next problem we're going to look at is with stock investments. So Slip Systems has no short-term investments prior to this year. It had the following transactions this year involving short-term stock investments with insignificant influence. Now think about it. So you go, okay, wait, insignificant influence, what does that mean? Okay, when I have a dividend, I just report it as dividend revenue. And at the end of the year, I have to report any stock in this category at its fair value. So this one is only for a year, but there's a couple transactions. Let's take a look. February 6th, the company purchased 3,400 shares of Nokia stock at $41 a share. So we could debit an account called stock investments, an asset, for the cost of the investment. So increase it, 3,400 shares times $41 a share, $139,400, credit cash for that amount. April 7th, now they're going to purchase 1,200 shares of Dell at $39 a share. Debit your stock investment account for the 1,200 shares times $39 each, or $46,800, credit cash for the same amount. Then they're going to purchase 2,500 shares of Merck stock at $72 per share. Again, debit your stock investment account, credit cash for the 2,500 shares purchased times $72 a share, or $180,000. So 3 purchases, 3 practices with purchasing stock in the insignificant influence category. And remember, that category occurs usually because you own less than 20% of the voting shares of stock of the company. So you don't have a big influence at all on the operations. Now, what happens on June 30th when you receive a $1 per share cash dividend on the Nokia shares? Well, you have 3,400 shares. You receive $1 per share, you'll debit cash because you're receiving cash, and you credit dividend revenue. You don't do anything to your investment account in this category. Credit dividend revenue. Now, on August 11th, they sold 850 shares of the Nokia stock at $46 a share. So let's do some calculation. We always calculate, first of all, when we make a sale, gain or loss, and that will always be selling price minus cost. So the selling price of the Nokia stock is $46 a share. So you're going to take $46 times the number of shares sold, 850. So 39,100. Now let's figure out how much those 850 shares cost. Back up on February 6th is when they purchased the Nokia stock for $41 a share. So take 41 times 850 shares, 34,850. Subtract from the 39,100, the 34,850. So they sold it for more they originally purchased it at, so they realize a gain. We record it just like when we sell a bond or a note, a debt investment. Debit cash for the selling price, credit the stock for the cost of the stock you sold, 34,850. Since you sold it for more than you originally purchased it at, credit gain on sale of stock investment. Again, you increase gains on the credit side like a revenue. You report it on your income statement in the other gains and losses area, and this increases net income. This is a realized gain. What happens on the 24th when you receive a 10 cents per share cash dividend on the Dell shares? Well, you have 1,200 Dell shares. If you receive 10 cents per share, you're going to receive $120. Debit cash, credit dividend revenue. Then you're going to receive $1.50 per share cash dividend on the Nokia stock you still own. Let's see how much you still own. You had 3,400 you purchased on February 6th. You sold 850 of them. So you only have 2,550 left. So multiply that by $1.50, you're going to receive $38.25. Debit cash, $38.25. Credit dividend revenue. And if you don't know how to record a dividend yet in this category, we'll give you one more practice. Received a 15 cents per share cash dividend on the Dell shares. So again, debit cash for 1,200 times 15 cents or $1.80, 180. Credit dividend revenue. Okay, so when you're in the insignificant influence category, you record your investment at what you paid for it. You record dividends in dividend revenue. Now, here's the next significant thing you have to do. Part 2. Prepare a table to compare the year-end cost and fair values of the short-term stock investments. The year-end values per share are: Nokia has a $40 market value, Dell 41, and Merck 59. So we're going to need to figure these out. So right now, Nokia, we have 2,550 shares, and we originally paid $41. So the cost, $104,550. What's the fair value of those 2,550 shares? We'll multiply them by their fair value per share, $40, $102,000. Same thing with the Dell. We originally bought $1,239 a share, so the cost is $46,800. They tell us the Dell shares are $41 a share at the end of the year, so the fair value, $49,200. The Merck. We originally bought 2,500 shares, paying $72 a share or $180,000. Wow, that market value went way down to 59. So at the end of the year, the market value is $147,500. Add up the cost. Whoops, I thought that would just do the cost. Currently, in our stock investment account, it has a debit balance of $331,350, what we paid for it. The fair value, though, is what the value needs to be on the balance sheet. So we have to find a way to decrease the value from $331,350 down to $298,700. And that's where our fair value adjustment account comes in. But in this case, we don't want to report more than is in our investment account. We need to report less. So we have to subtract from the 331,350. So that means our fair value adjustment account has to have a credit balance in it of 32,650. The stock investment account will have a debit balance of 331,350. We'll then subtract the credit balance of the fair value adjustment account from that and report the difference on the balance sheet, 298,700. The other side of this journal entry is we debit unrealized loss income, because this account goes on our income statement with other gains and losses and decreases net income. So here is what our balance sheet will look like when we're reporting this current asset stock investment. And they tell us it's a current asset, short-term stock investments. So we're going to have in our current assets, here's our stock investment. The account currently has a balance of 331,350. That's what we paid for them. But we need to decrease that account by 32,650, so we properly report the stock investment at its fair market value at the end of the year, 298,700. Now, part 5. How do these short-term stock investments affect the income statement and the equity section of the balance sheet? Well, dividend revenue would be a total of 7525. So we get that by saying, well, when do we credit dividend revenue? Here's our first one, 3,400 plus 120 plus 3,825 plus 180. So the total dividend revenue the company will report is 7525. The company also had a gain on sale of stock when they sold part of the Nokia up here, 4,250. Remember what I told you, that goes on your income statement. And the company also will reduce net income for this 32,650 from the unrealized loss. So the overall effect on our income statement, positive 7525, positive 4,250, but a loss is a decrease. So subtract 32,650. So overall net income will decrease from these transactions 20,875. Now, how does this affect the equity section of our balance sheet? Well, that decrease in net income would also cause retained earnings and equity to decrease. And that's all we're saying there. Okay, so the unrealized gain or loss in this category of investment affects net income. That was a great problem to see the whole picture of these investments. Last problem, 15.5b. Brinkley Company began operations in year 1, had the following transactions and events in its long-term investments. Prepare journal entries to record these transactions and events for Brinkley. Assume that Brinkley has a significant influence over Block with its 25% share. Oh, this is going to be fun. So January 5th, Brinkley purchased 20,000 shares, so 25% of Block's common stock for $200,500. So remember, when we have significant influence in the ownership of stock, now we have more influence over the operations of the company that we purchased. So we do the accounting a little differently. We call it the equity method. And your author likes to just debit equity method investments so that you remember you got to use the equity method here. And this only applies to stock. And then credit cash, still an asset account. Then August 1st, Block, the company Brinkley purchased, and we're Brinkley, declared and paid a cash dividend of $1.05 per share. So Brinkley owns 20,000 shares. times $1.05, they're going to receive cash of $21,000. So we debit cash, but we don't credit dividend revenue in this method. We credit that asset investment account. So we credit the equity method investments. We wait till the end of the year to show any revenue related to this company that we own. And here's how we do it. Block's net income for the year is $82,000, and the fair value of its stock is $11.50 per share. Well, good for them, right? We ignore the fair value in this method. Who cares? They put it there to throw you off. What we focus on in this method is how much Block's net income was, because Brinkley, us, needs to record 25% of it as revenue. So 82,000 times 25%. Now we're not getting any cash from Brinkley or from Block. We're going to debit, though, our investment account, $20,500, and then credit a revenue account, earnings from equity method investment. That will go on our income statement in other revenues, gains, expenses, and losses. So the methodology behind this method is, since you have so much influence over the operations of the company, you don't get to record revenue related to this company when you get a dividend. Oh no, you're going to record revenue as the company is earning the income. And then when you do get a dividend, you'll reduce your investment account. So here we are. This year, this company is entitled, so Brinkley, us, is entitled to a $20,500 of the net income of the company. Now, during this year, the company did receive $21,000 of it. So a little bit more than they were actually entitled to, but that's okay. We credit the equity method investment when we receive a dividend. We debit it when our company we have this significant influence over makes the net income. And we report that as revenue on our income statement in that year. Year 2, Block declared and paid a cash dividend of $1.35. Same situation. We take the 20,000 shares that we own of them times $1.35, debit cash, credit the equity method investment. At the end of year 2, when Block's net income for the year is $78,000, ignore that fair value stuff. We're going to take $78,000 times 25%, debit the equity method investment, credit the earnings from equity method investment. All right. Now, what happens with this last one? Well, here's what we have to do. Do a little T account. Equity method investment. We need to know what the current balance is in that. So we start with a $200,500 debit balance. Then we're going to credit it for $21,000 from the August 1st transaction, but then we debit it for $20,500 from the December 31st. During year 2, we credited for $27,000, but debited for $19,500. So I'm going to add my debits together, $200,500 plus, $20,500 plus $19,500. Subtract the credits, minus $21,000 minus $27,000. So right now, at the end of year 2, the balance in my equity method investment is $192,500. And whatever the balance is in that account, that's what gets reported on the balance sheet. There's nothing with fair value. Why is this important? Because January 8th, right after the end of year 2, we sell some of this. And we sold 5% or 1,000 shares for $12,025. You could see the cash there. But here's the question. How much do you reduce the equity method investment account by? Well, you say, what is the current balance when we make the sale? We just figured that out, $192,500. That was for all 20,000 shares, or 5%. So $192,500 divided by 20,000. Right now, the cost per share, how much did each share cost us, is $9.625. Or, and then you could say, I sold 1,000. They cost, as of today, 9.625 cents, or $96.25. Another way you could do this, the current balance in the equity method investment account is $192,500. If I sold 5%, multiply that by 5%, and you get the same result. And that's what they do there. So I showed you two different ways of calculating that. So January 8th, when they sell this, they receive $12,025. How much do they reduce their equity method investment account for? 5% of its current balance. And then the difference, in this case, they sold it for more than its current value on their books, is a gain on sale of stock investments. Again, gain account reported on the income statement. It'll increase net income. It's reported in your other gain and loss area. So down here, they're doing what I did in the T account, to show you how we got that balance of the account when the sale occurred. But that's how you complete that. Okay, so we just reduced our equity method investment account by $96.25, and we may need to reevaluate if we still have significant influence. Now, in a more advanced accounting course, you learn how to do that, but we're not going to. We just want to get the basics about investments. Okay, so we took a good look at the major areas we saw for this chapter. So please make sure you practice and let me know if you have any questions.